What's up, people? Today I want to talk a little bit about risk versus reward in the stock market. And by that I mean that you can have pretty safe investments even in the stock market where you don't really have to worry about anything. You don't really have to worry about losing money. The problem is that in the short term, things happen that you cannot foresee. And there's investments for that are safe. Even some that are completely safe, where there's basically no risk of losing anything. Obviously, there's no perfectly safe system. So even in the first case here, a savings account. So the money is FDIC insured, which means that the US government, if you're living in the US and having a US savings account, so that might not go for all of you, but there's similar systems in most of the developed world. So basically, any money that you have in a savings account, and the limit in the US is $250,000. So up to $250,000 of that is insured by the US government. So even if the bank completely disappears, goes bankrupt, goes out of business, never opens any of the branches again, the money is safe, you will get the money back. So the risk for you not getting the money back is basically the US government failing to provide enough money to a bank to pay you for the money that you had. So I would consider that perfectly safe because I don't see the US government going under and filing for bankruptcy. But, as I said, anything can happen. But if you have it in cash, that's even less safe, right? The US government basically guarantees that the cash you have has any value at all. So if savings accounts are not safe, cash isn't either, so there's nothing. You might just have to raise some chickens so that you can trade for a t-shirt. Anyway, so savings account, obviously the safest way to, I wouldn't say invest your money, to, park your money until something better comes along. Because savings account generally either doesn't or barely does keep up with inflation. So if you put $100 into a savings account right now, and in 10 years you have $125-ish dollars, maybe $130-ish dollars, that $130 will buy you the same amount that $100 will buy today. So you haven't really made any money. You've basically parked the money. And that means if you keep your money in cash, that will definitely lose value. So, the $100 that you have right now, if you don't put it in at least a savings account with a good interest rate, in 10 years it's going to be worth like $90, maybe even less. So next we have government bonds, and actually everyone can buy those, and you can even buy those for free as far as I know. So there's a website where you can buy government bonds, and they can even be very short term, like 4 weeks, something like that, where you can invest your money, and at the end you get like 2% more than you put in. So 2% APR kind of. Might even get a bit more if you go for 10 years. Currently the interest rate is terrible, but usually you should be getting like 4-ish%. Right now you don't. Nothing I can do about it. Sorry. So number 3, hitting the like button. Still a very safe investment, but we're getting to the more dangerous ones. So the S&P 500 index fund tracks the 500 biggest companies in the US right now, which means there is a little bit of turnover where companies fall out of the index, other companies get added to the index, but basically it's the 500 biggest companies in the US at any given time, and you're basically expecting a 6% return on your investment in an index fund like that. That is already adjusted for inflation. So before inflation, you're looking at 7 to 8%. So if you put $100 into an S&P 500 index fund, you're looking at about $200 in 10 years. Next, we have a NASDAQ index fund, or a more tech-heavy index fund. Tech companies tend to grow far faster than traditional companies. Like, there's no way a Walmart is growing at 40% a year. There's no way that a bank grows at 40% a year. So tech companies can grow at 100%, can even grow at 200%. So a tech-heavy index fund is less safe because there was a dot-com bubble. There were other bubbles. And companies can go under very quickly, but they tend to grow very fast. So that's why it's less safe than an S&P 500 index fund, but you tend to make more money on average. Just that sometimes you might end up with less money. In the long term, if you never touch your money for 10 years, 20 years, this is still very safe. You are going to end up with more money than you had before. You're going to have significant gains. I would say that you'll never end up with less than 5% average on an annual basis, even in a NASDAQ index fund, even in the worst case scenario over 10, 20 years. So still fairly safe. And then we have diversified stock picking. So you don't like the stocks that are currently in an index, or you don't like some of the stocks that are currently in an index. So you pick your own stocks, and you pick a lot of them, and you invest your money in a very diversified portfolio. The problem you're going to have at this point is that you're going to pay a lot of money in transfer fees, in transaction costs, because every single stock that you pick, you're going to have to pay at least $5 to invest in, and you're going to have to pay at least $5 to sell it. So obviously this is really not the way to go if you don't have probably tens of thousands of dollars, maybe even more. And before that, you might not worry about being so diversified. And if you wanted to be diversified, you would just pick a S&P 500 index fund. So if you do pick your own stocks and you have a well-diversified portfolio, you have a significant risk still, because any one or two of the stocks going down can drag your whole portfolio down quite a bit. But over the long term, it's pretty safe, but you're going to have to watch it. You're going to have to figure out all of the stocks that you have. Are they still doing well? Should I still be in them? And all that kind of thing. Well diversified means that you're probably having, tens of stocks, and keeping track of all of them on a daily basis is probably more work than it's worth. So at that point, probably just throw it in an index fund. Don't worry about it. It'll go up, it'll go down. At the end, you make more money. Then we have picking few stocks, very few stocks, or one stock. So the swings with picking fewer stocks are obviously going to be bigger. If you don't diversify the fields that the companies are in, if they're tied closely together, they will tend to go up and down closely together. So we're getting into very dangerous territory. And we're going into the territory where you're going to have to do a lot of research into the stock that you're investing in. You're going to have to watch it on a daily basis. You're going to have to see all the news that comes out of the company, what the analysts are saying, what the financials are saying. You're going to have to keep up with it pretty much on a daily basis. So if you don't want to do the work, again, this is not for you. And now the most dangerous thing, options. And first of all, if you don't fully understand options, stay away from them, because the downside can be potentially unlimited. What does that mean? It's possible for you to invest $1,000 that you have into options and lose $1 million. You can actually lose more money than you have, and that has happened before. So I would tell pretty much everyone to stay away from options as much as they can, because there is a huge downside that you can mitigate, but we're getting into the weeds of things, and the strategies that you have for options are either very risky or very costly. So trading options, not recommended for basically anyone. So that is the riskiest one. If you want to invest your money in the stock market and you don't want to do any work, throw it in an S&P 500 index fund. You're making significant gains every year. There'll be some years where it's down, but over a 5-10 year span, you're basically never going to be down. So I would recommend, if you're starting out, you want to invest, you want to put your money in stocks, buy some S&P 500 index fund, leave it alone, don't touch it for years. And in the end, you're going to have significantly more money than you started with.